Welcome back, everyone. This week we're going to be discussing Tidewater's Q4 2023 update. The link to this article will be in the description box if you're interested in clicking over and looking at it, as I will have some articles and such hyperlinked inside this article which you might be interested in looking at. So with that out of the way, let's get into this. I'd like to start this off by reminding you what happened when Tidewater released their Q3 numbers back in November. Numbers, may I remind you, that I thought were quite positive. I even bought the dip. Back in November, the stock fell roughly 15% within a couple of days of them releasing their quarterly results. More specifically, I believe the stock dropped 14% in a single day, and then it continued to fall lower. Well, in the past 2 days, the stock is now up, I believe, 15 to 20% due to their Q4 release. Well, this time around, the stock is up roughly 15% days after their Q4 release and is sitting at an all-time high post-bankruptcy. But why? Because they're committed to ESG. LOL, gotcha. The reason that people are seemingly getting excited about Tidewater is because the magical 12-month window is closing in on them. Wall Street doesn't generally care about things until it's 12 months or less out. Well, guess what? Tidewater's money machine is getting ready to go brr. Just look at their headline figures. They're comping serious gains quarter over quarter and year over year on their numbers, and Wall Street likes their year over year figures. You can zoom in on this, pause the video, click the link in the description to read it. I'm not going to go through all of their full year 2023 highlights, fourth quarter 2023 highlights, and the share repurchase program. But like I said, pause the video, look at the screen, do whatever you want to do. The below image is courtesy of a Twitter OG of shipping. Link in the description. Or link in the article. Article's link is in the description. Raymond James has put out a price target of $97. And they have their recommendation. 2024 looks promising with further revenue, margin, and day rate growth each quarter. So it's only looking good. And incrementally progressing quarter after quarter after quarter after quarter, as opposed to many times in this industry or other industries you hear second half of the year, first half of the year. Well, in the case of Tidewater, it's each quarter is going to look better than the quarter before for the next year. In this highlighted red box, you'll see, as highlighted in our most recent write-up, it generally takes approximately 6 quarters to roll over the contract base, which implies a run rate of upwards of $1.2 billion in EBITDA. We're reiterating our strong buy rating and raising our 12-month target price to $97. Now, that's interesting, but, well, let me look. Or let me continue reading here instead of going off on a side tangent. With 2022 adjusted EBITDA of $220 million and 2023 adjusted EBITDA of $386 million, you might reasonably say, at that rate, how are they going to get to $1 billion before 2028 or 2029? In which I would say, gradually, and then suddenly. The less glib answer is a combination of day rates increasing, OSV contracts rolling over to new higher day rates, and potential M&A. And that is the serious answer. Now, what I wanted to point out here and did not write about is, so if they had $386 million of adjusted EBITDA for 2023, where or when are they expecting this $1.2 billion in EBITDA? Because what they're saying is that's $800 million more than the current year's EBITDA. or last year's 2023 EBITDA, which is a 200% increase that they're projecting. So then you could say, well, the stock's at 80, they're calling for 96. We'll just call that. So they're essentially calling for a 25% increase in the stock price, yet at some point they're calling for a 200% increase in EBITDA. So it might be worthwhile to ask, well, how long before they think that happens? And I don't know the answer to that, but it's worth thinking about. Conspiracy theory. Speaking of M&A, there's a conspiracy theory floating around in the world that's at least worth knowing about. Hornbeck, a name that you should recognize for no other reason than that it's in Tidewater's presentations, has recently filed an S1. According to Hornbeck's S1 filing, they're a large player in the Gulf of Mexico and have some exposure to Brazil. Then you have Tidewater saying this in their Q4 call. This is from Quentin, their CEO. Well, we certainly focused on fleets that are probably more than 15 to 20 in our analysis, just because that just helps move the needle with a fleet of 220 vessels. I'm not against doing 5 and 6 vessel acquisitions, but we just get more bang for our buck with our larger transactions. Now here's the interesting part. Quote, I've been focusing recently in the US, Gulf of Mexico, and in Brazil, but I'm not adverse to picking up vessels anywhere around the world, end quote. So here, Hornbeck filed their S1 a few months ago with no recent updates that I'm aware of, and they are a predominant player in, I think they have 75 vessels, even though the S1 filing says they have 75 vessels, and then Tidewater's newest presentation claims that they have 65 vessels, so whatever. But they have, according to this image, in the Gulf of Mexico, they have 21 active OSVs and 9 active MPSVs. So that's 30 vessels. So that's, call it 40 to 50%, 35 to 45% of their vessels. So Tidewater might be interested in acquiring that. Who knows? Who knows what discussions are happening behind closed doors. Tidewater doesn't mind M&A, so if the distressed holders of Hornbeck are interested, I'm sure Tidewater would be glad to take those OSVs off of their hands. In conclusion, I've said it before, and I'll keep saying it. The offshore game is one of 3 key components: day rates, utilization, and new builds. So let's go through them, shall we? Day rates. Here's an image. Look at it. Do whatever. Day rates, up and to the right. Utilization, up and to the right. New builds, down and to the right. That's a good thing. The management team at Tidewater isn't seeing this changing anytime soon either. I'll read this. Thank you, Quentin. As we've observed over the past few years, the recovery in our industry and our business has been largely driven by the limitations of vessel supply. Demand is certainly more constructive than it was during the depths of the pandemic, but vessel supply has historically been the primary driver of the financial health of our business. As we survey the landscape of future vessel additions, there are multiple factors that provide us confidence in our outlook, not only for 2024, but for the intermediate to long term. First, the current order book remains at an all-time low with a minor number of vessels added during 2023. This is clearly a supportive indicator of limited near-term supply additions. Second, shipyard capacity remains a fraction of what it once was during the recent peak of shipbuilding capacity in the mid-2000s, with many remaining shipyards out of capacity until at least 2026. This is a particularly relevant data point as the build time to complete an OSV is estimated to be between 2 years and 3 years. The combination of limited shipyard capacity and the lead time to construct a new vessel provides for a significant runway of time before a material number of new build vessels could deliver and hit the water to alter the supply picture. And here you see the OSV, end quote, and here you see the OSV order book development. That is down and to the right. So, man, that's impressive. That is an impressive chart for a decade and a half, let's call it. So there you have it. Another good quarter, and the 3 key metrics that I care about are all looking good. The only thing to complain about is how I don't own more. But of course, I didn't feel that way when it was 40% lower from today's price back in November. As always, I try to size my positions where I wish I owned more when they're doing well, and I'm okay adding when they're not doing well. Oh, before I finish this, I'd be remiss to not mention that they issued another share repurchase agreement. Nowadays, if you're not buying back stock, you're doing it all wrong. Thank you for listening, and please know that Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber to both my Substack as well as YouTube. With that out of the way, thank you for watching, and until next time.